Hey everybody, welcome back. My name is Scott Newhouse. I am excited that you are with me today because we're going to talk about the subject that is on the tip of all of my clients' tongues. That's the Trump tariff wars that we've been going through really since he came back into office. This is not going to be pro or con tariffs. I'm not going to explain, what the tariffs were and what they're going up to. I'm not going to be explaining, what we import and export from certain countries. Not really interested in that. I mean, maybe I'll do that in the future, but that's not what this episode is. This is honestly kind of a pep talk of, kind of trying to stay the course and really understanding why we need to stay focused on a long-term investment plan despite the uncertainty and really the terrible, news coverage that you see every day of, the Dow down 600 points. There's red on the screens. People are hyperbolic. People are talking about recessions and depressions and just a really lot of terrible news. So this is really trying to say, hey, let's take a step back. Let's just look at everything that we have going on. So let me see if I can pull up my first thing that I have here. And so I've got four main points that I want to go through. And so the first one that I want to go through is you've got to zoom out. We have to zoom out. And so if we're looking at the last 1 month, S&P 500 largest companies in the U.S., absolutely terrible returns. Negative 7 point, this is changing automatically while I'm looking at it. Wow. A negative 7.36% over the last month is our return. We keep that up. We're not going to have any money by the end of the year, but we're not going to keep that up. And I really shouldn't be making those kind of jokes. Okay. So that's 1 month. Negative 7.36. Absolutely terrible, abysmal. Now let's do year to date. Year to date, also not good. Negative 3.22%. And so not good, but that's not tragic. Now let's go to 6 months. 6 months. Whoa, look at that. We're actually up 0.79%. That's not great. I mean, we need better returns than that long term, especially over your retirement. But hey, we're back where we were 6 months ago. So not the end of the world, but not good news. 1 year. Whoa, we're up 10.27% over the last 12 months. That's fantastic. The number that I use for my clients who are 100% in equities when I make my projections, and I do really simple projections, kind of just focus on that retirement number, but I use 7%. That's for people who are comfortable, close to 100% equities. The historical return on that has been around, 8 to 9 to 10%. I just don't like to guarantee my clients that we're going to get, 10% returns because that makes the math wacky if we get worse returns. So if I do 7% and we get 9%, that's fantastic news for my clients. If I say we're going to get 10% and we only end up getting 7%, then I've got a lot of egg on my face when they get to retirement and they can't retire the way they want to. So I do 7%. If you're in some kind of, stock bond portfolio, maybe 5 to 6% assumption in terms of what your returns will be. And we all know that that's not a guarantee. My point is, if you've gotten 10% over the last year, that's really a really good historical return. Now that's all stocks, and so bonds are going to, lower those returns, but that's still not bad. So the first lesson I've got just for us to get through what we're seeing in the tariffs and in the news is we've got to zoom out and we've got to look at the big picture context of how our portfolios have done. And then I'm not even going to go into the 5-year because that's just going to be ginormous and that's going to skew things just way out of balance. But if you're up over the last year, that's still really good news. Now, one other thing that we got to keep in mind is that we've had a really quick turn down. And so at least over the last month, we're down 7.36%. If you take it from the high, which I think was on February 18th or 19th, I'm not sure the exact date, but it's around there. If you take the high and then going to where we are now, we're in correction territory. And what correction territory means is we're basically down 10% from the highs to whatever level we're at right now. And that was actually as of last week. I think I'm recording this on a Monday. I think Friday was a good day in the stock market. So maybe we're up a little bit maybe we're down less than 10% now, but at least last week we were down more than 10%. And it was a really quick time period of going from all-time highs to down 10%. And it was actually on this chart that I'm going to put up on the screen, it was one of the quickest number of trading days to get to a 10% correction in the last 75 years. And so if we look at the last, that 75-year period, there are 1, 2, 3, 4. There were only 4 periods where there was fewer. Is my math right? 1, 2, 3, 4, 5. Wow, that's really bad math. So if we look in the last 75 years, there were 5 periods that got to a 10% correction quicker than what we got to just in the last month. And then one took 20 trading days. And this time it took us 16 trading days. My point is, if you look at all of these quick corrections over the last 75 years, the 1 to 3 to 6 to 12-month returns are pretty darn good. So we've got 6 sample sizes here. 5 of the 6, we have positive returns over the next 12 months. One of them, we do have a negative 12% return. That was during the tech bubble in the early 2000s. But the other ones, again, after you go quickly from all-time high to down 10%, the returns are 14% 12 months later, 21% 12 months later, 25% 12 months later, minus 12, up 5, and up 27.9%. That's absolutely phenomenal. So my second point that I'm trying to make here is, we did have a quick downswing, but we could have a really quick recovery, and we could have a really good 12 months from here. So please don't sell, because we don't know when it's going to end, but it will end. And then those 12 months after that are going to be really, really good for us. So we've got to, historically, they have been really good for us. I can't make any guarantees on this show. Okay. The third point that I want to make, and I have been getting this a lot, and I encourage my clients to ask me any and every question that they have. So I'm not lamenting the question, but I have heard, maybe this time it's different, Scott. Maybe this time with Trump in office and the tariffs, it's just going to be different from anything that we've seen historically. The issue that I have with this is that we obviously, and I know my clients know this, but we did go through a first term with Trump. We saw really great stock market returns. And you know what else we saw in his first term? We saw a lot of tariffs. There were a lot of tariffs happening in the first term against countries like China, South Korea, Canada, the European Union, India, and Mexico. So we saw tariffs all across the world, and we saw a high number of those tariffs in his first term. And the end result is that the stock market was up around 68%. Let me pull this up. Stock market. Yeah, according to U.S. Bank, the S&P 500 gained nearly 68% in his first term. Just to give you some context, Biden, the stock market was really good in his 4 years as well. It gained around 57.85. Again, that's according to U.S. Bank. So my point is, we have seen Trump institute a lot of tariffs, threaten a lot of tariffs before. He did it in his first term. Whether you're pro or against tariffs, I don't think you need to be selling, and I don't think you should be selling your stock market portfolio, because we've seen the stock market weather it and improve upon it, even despite the kind of chaos that the tariff wars do bring. My fourth and final point, at least for now, I've got one more idea that I might make it a separate episode. But my fourth idea is that it's just not too late to diversify your investments. And so I've been talking a lot about the S&P 500 largest companies in the U.S. They've done phenomenal over the last 10 to 15 years. And you look at this chart that I have pulled up. It's divided in your. If you don't, see the video, I've got a chart that divides stock market returns by large, medium, and small size companies in the U.S. And so a blend of large size companies in the U.S. has returned around 10.78% over the last 10 years, medium sized companies around 7.35%, and then small size companies around 6.02%. And so when I say it's not too late to be diversified, I'm really thinking about a lot of my clients who come to meet with me, and they only have the S&P 500 in their account. That's the only investment that they have. It has paid off for them in spades the last 15 years historically. That's not always the case. From 2000 to 2009, large cap companies actually lost 1% a year, whereas medium and small actually had positive gains. And so if you were only in large cap during that decade, it would have been really tough for you, especially if you're retired, because then you're making distributions, you have inflation, and you're getting a net negative annual return on your portfolio. That's a disaster in retirement, which is why we need to diversify. The other way you can diversify is, again, on the chart that I'm showing, it separates between growth size companies that are growing really rapidly. They're reinvesting their cash flow. Think about like tech companies, risky companies, scientific companies trying to develop new, drugs and whatnot. Companies like that, companies like Amazon in the 1990s, when they're not taking a profit because they don't want to pay out a profit to their shareholders or via dividends, they want to put all their money back in the business. And so what we see here is that we see growth companies have drastically outperformed value companies, which are more stable, slow and steady companies, companies like a Walmart or Target, grocery stores, Lowe's and Home Depot. They have more consistent revenue. If and when they make profits, they do pay out those dividends to shareholders. They're just not growing as rapidly and reinvesting in the business as much as the growth size companies. What we see, and I'm not going to go through all the numbers here, what we see in the last 10 years is that growth focused companies have outperformed value oriented companies, and pretty drastically. Now, here is the big change though. Year to date, value is actually outperforming growth. And it's across the board among large, medium, and small size companies. So if you've been focused on the things that have won, quote unquote, won the last 10 years, things like growth companies, tech companies, risky assets like Bitcoin and cryptos and all of that stuff that I'm not really in love with. But if you've been overweight in terms of those three items, I honestly think now's a fantastic time for you to rediversify your investments. If you're only in large cap, you got to add in small and medium. If you're only in US, you've got to add international. And I don't have this up on my screen right now, but international is beating US stocks so far year to date. And then also, this is really interesting, we actually have bonds beating the stock market so far year to date. What I pulled up earlier is that the stock market, large, medium, small in the US is down around 3.96% year to date, whereas the Vanguard total bond market, and that's, short-term, intermediate, and long-term bonds in the US, it's actually up around 1.75%. So I think we're going to see kind of a resetting of investments potentially this year and beyond. So maybe large size will not outperform small and medium. Maybe growth will not outperform value. Maybe the US will not outperform international. And maybe, and this happens every once in a while, not often, but maybe, bonds will actually outperform stocks. So if you are not fully diversified, you're going to miss out on whatever this next bull market's going to be. The last 10 years, it's been large size companies, but we don't know what the next 10 years will be in the future, which is why we need to stay diversified, especially if you're in retirement. So 4 ideas, 4 ways for you to think through how you're going to get through the Trump tariff wars. I really do think the best plan is to diversify, stay the course, think long term, and just really be confident in your plan, in your distribution strategy, and just controlling what you can control, which, maybe it means rebalancing, but it doesn't mean selling out and cashing out because the news is too bad and you think we're never going to bounce back from this. Because again, we've been through it in the first term and we bounced back, and I think the same thing is going to happen eventually in the second term. So that's all I've got for today. I hope you guys enjoyed it, and I will see you next time.